Hello and welcome everybody to the Dairy Signal from Professional Dairy Producers. It's the first Thursday in September. The kids are back in school and the calendar pages are just whizzing by in a crazy fast fashion. But I guess that happens every year, doesn't it? We're excited today to bring you another market update from our good friend and business partner, Ben Buckner at Ag Resource Company. And before we dive in to the updates that he's going to share with us, I've got three things that I want to bring to your attention. The first is that I want to give a hearty thank you to our program sponsor, Dairy Management Incorporated. They are a checkoff program who is making every drop count in the way that they make sure consumers understand what dairy producers are doing to bring to them and their tables a nutritious, wholesome product day after day. Thank you, Dairy Management Incorporated, or DMI, as we like to refer to them as. We really appreciate your support. Second thing I want to draw your attention to is that throughout the course of today's program with Ben, you're probably going to have a couple of questions that come to mind, and we want you to be able to present those questions to Ben. So the way that you're going to do that, when you're looking at your viewing window, in the bottom right corner, there will be three dots. And when you hover over that, there will be an option for you to ask a question. Click that, and you can type in your question there, and then I will see it on my end here, and then I can ask Ben the question that you have. It will also give you an opportunity to enter your name. You don't have to type in your name. I'm the only one who would see it. But so make me laugh. Tell me you're Elvis or Santa Claus or Ringo Starr or something, but you don't have to fill in the name section. And the third thing I want to draw to your attention is regarding our Dairy Advanced Continuing Education credits. We know, because we've heard from you, that it's important to many of you to track your continuing education credits, and we want to make sure that you get every credit coming your way. At the very end of today's program, there will be an automatic prompt that allows you to take a quiz that you have to answer correctly so that you can get the full value of having listened to today's program in the form of Dairy Advanced Continuing Education credits. So follow the prompts to do that, and make sure that you submit your answers to the question as many times as it prompts you to hit submit. I think that's it for now. So with that, no further ado from me, I'm going to hand it over to Ben Buckner with Ag Resource Company. Take it away, Ben.
Well, thank you so much, Shelley. Pleasure to be here as always. And we will just jump into it because there's a lot of things going on. And I guess our idea now is not much has changed. I mean, you're going to see a lot of the same info you saw 2 weeks ago, but maybe the tides are turning. And I guess another 2 weeks having gone from the calendar, there's a little bit more concern with respect to U.S. trade policy uncertainty or souring relationship with Russia, China specifically, some other countries in East Asia. So, Ag Resource has been around for 38 years and has chosen to do no trading, no brokering. All we do is advise and help the U.S. producer navigate pretty chaotic agricultural market. And so, with that said, it pains us, but it does seem like the winds are changing such that everything's a little bit more negative, which goes both ways. If the feed market outlook is one of probably oversupply, and does that last for 12 months, 24 months, 36 months. So that's the benefit, I think, to the end user community, dairy included. But also the milk markets are just kind of swimming in supply globally at the moment. So we do want to be very clear in that we like hedging forward milk production, especially something that we've talked about over and over again. In that first quarter into April 2026, I think it could get pretty ugly, maybe the word, if things continue to go like they've been going weather-wise in places like Europe and New Zealand. So we are worried that milk supplies continue to balloon and value does get extracted, especially as demand seasonally wanes like it always does during the winter months. So locking in milk feed ratios, I think, makes good sense. locking in forward milk prices. That's something we just want to communicate to the dairy space in the US. We're not sure what's to change the sort of recent downtrend given what we've seen production-wise in a lot of places, and are concerned about, trade barriers, not trade improving over the long term, or at least in the next year or two. So the outline for this hour is fairly simple. We don't want to keep it too complicated, and the U.S. Markets are debating the nuance of a final corn, soybeans, and even spring wheat yield, and that's fair. That is always the case. The first week of September, this debate probably doesn't end until we get to 40 or 50% harvested, and we'll have a much better idea of U.S. crop sizes, Northern Hemisphere crop sizes. But the general theme is still one that they're going to be large. How big is the question. That's what's being debated today. But there will be no shortage of, feed supplies, corn, soybean meal, and especially wheat in the world, over the next 4 to 6 months. I think if one is to be bullish of feed, it would come from a supply dislocation somewhere else in the world, the Southern Hemisphere specifically. I think we can kind of debate how high is high during the late winter and spring period next year, but for the rest of calendar year 2025, it does look like grain supply is adequate. We're looking at cash basis levels in some certain places, and we'll touch on that. And they're kind of giving us guidance to suggest that those markets are oversupplied, and the idea is they're oversupplied today, not in 30 or 45 days from now. And China is still a problem, and for a lot of the reasons that we've touched on, and people that attend the Dairy Signal know more, I think, than the rest of the market. But it is, of course, trade policy, and we'll touch on this too. China still, on September 4th, is yet to buy a single bushel of U.S. soybeans for delivery in the 25-26 crop year. We'll talk about why that's a problem. They've yet to buy a bushel of sorghum as well. And the cascading impact of sorghum on the feed market and the spine of the central U.S., that's a concern to us. But also the things we've touched on before, macroeconomics. There are still a lot of structural issues in China, and so that, I think, hinders the ability of the U.S. and China to move forward negotiations. And also want everyone to think about, the potential trade deals, or every single day on the lookout for signs that we are moving forward with respect to negotiations with China. But it also needs to be agricultural specific. And it was in 2020. That was when we saw, demand growth and the world's demand driver being Chinese imports. But will it include agricultural this time around if something gets done? Or is it just about trade imbalance and chips and airplanes? So I think we're just a long way off to even thawing relations between the U.S. and China. And that's a problem for markets like soybeans specifically, maybe dairy 12 months from now. It's just something we've got to be cognizant of. And otherwise, there's really no secrets or nothing really behind the curtain here with respect to this outlook. Weather just continues to cooperate. I know it's been dry in places like Ohio the last 3 or 4 weeks, and in fact, August rainfall there may be some of the lowest in recorded history, going back to 1895. But we still think nationally, USDA's corn and soybean yield forecasts are about correct. At this point, having revised them upwards so significantly in August, the probable move is down, but maybe it's 2 bushels in corn, half a bushel in soybeans. Otherwise, looking at Southern Hemisphere patterns already being nearly ideal, and it's far too early to talk about anything except for how weather is impacting wheat in Australia or wheat in Argentina, but no drought in the Southern Hemisphere today. If things look normal or continue to go normally for the next 3 or 4 months, that will be the 4th consecutive crop cycle that the exporting community has obtained yields at or above trend. So just kind of a normal part and parcel of the cycle of ag markets. We have avoided weather issues, and so we're building supplies. Milk too. I mean, there is kind of a lagging in feed costs go down. And let's say today, and I think this is generally the case, we need sustained milk production growth globally. That's kind of a fact, but how that gets accomplished, it does not take as high of a milk price given feed costs where they are today and where they probably will be for the next 12 months. So I think that's part of why the milk markets shed so much premium. I do think there is still some measure of value in the U.S. dairy space where prices exist today. Let's think about the cash butter market last night on a national average traded at $2.01 per pound. That's down 75 cents from where we were 60 days ago. But there is value here. We are still exporting tons and tons of US dairy products. Our share of world trade will be the highest I think that it's been in a couple of decades. And this is hot off the presses. This is brand new census data released by the Commerce Department this morning. Total dairy products of all kinds exported in the month of July are 249,000 tons. That's a record for that month, down just slightly from last month, which was June, which was an all-time record for any month. So it does seem that weaker prices in the U.S. do translate to a large disappearance. So I think that breaks do entice end users and importers to come to the market. Cheese exports, not surprising given the discount of the U.S. cheddar market to everywhere else, especially Western Europe. We saw exports of 52,000 tons, and that's a number that's been unmoved for the last 5 months. So we're making a lot of this stuff disappear and a lot easier because the U.S. is so competitive in the world space. And I still think that holds, especially thinking about cheese and class 3 milk. It's hard to be bullish of class 3 milk. And we've all seen the recent price trend. We know what charts look like, but to an end user or an importer, I think there is value as you get closer to $17 a hundredweight. I think that the rest of the dairy space can make a lot of money at $17 basis class 3 when you're thinking about cheese processors, cheese importers especially. But longer term, is there a growing risk, at least slightly, to the U.S.'s share of world trade? And we'll kind of touch on, we're just seeing really no production hiccups in Europe or New Zealand or Australia. And Argentine production has been pretty incredible the last 6 months. So I think on the margin, unless you have a real big driver of demand for protein and fat above and beyond what we've seen the last couple of months, the U.S. probably gets less of a piece of the pie starting, the middle of winter 2026. So again, communicating very clearly, we are concerned about forward dairy supply and demand, and so too is the market. The market has seen these numbers. It kind of lived and breathed these numbers during the middle of summer and was kind of unmoved by them. So exports are good, but production growth in the U.S. and everywhere else is offsetting this, and then that's the concern really that continues. Maybe it even gets worse for the next 6 months. But we are exporting record tonnages of things, cheese, even butter. Total exports of butter in the month of July were 12,200 tons, a new all-time record. We haven't seen anything close to this since 2014, which makes sense. If you remember, cash butter in Europe briefly during the middle part of summer, near $4 per pound. It was $1.40 above the U.S. market. What jumps out to me here, and why I still think for maybe the rest of 2025, or at least into the end of the holiday season, cash butter at $2 is pretty valuable, I think. We saw demand growth from the usual suspects, a lot of Latin America, Southeast Asia, modest growth there. But we also exported a pretty sizable amount of butter to Western Europe, including the Netherlands, which is a pretty major producer. And we also exported butter to Australia, which is a pretty sizable producer of butter and exporter in their own right. So we kind of highlighted, and we'll touch on this shortly, just the incredible discounts of the U.S. butter market to everyone else. It did start to change trade flows, last spring, and is doing so to the extent that exporting countries are importing U.S. butter. And so that just shows you, I think, how competitive the U.S. butter market is and still is today. And when we look at the snapshot of global prices, I think two things are true. The U.S. market, whether it's cheddar or butter or whey, still incredibly competitive, historically competitive, historically cheap compared to our major competition in Europe and Oceania. The EU butter market still $3.65. New Zealand last week $3.25, and the US near $2 per pound. So the discounts are getting wider. Cheese as well. US cash cheddar, about $1.70 per pound today. New Zealand's $2.08. Europe still at $2.40 today. So I do think we're going to at least see these export numbers when we have our meeting 1 month from now. Going to look very similar. Records for the month, maybe all-time records. Whether the market cares about it is another thing. But the second thing, when you look at these graphics, is the kind of weighty nature of these markets. So it was one thing to find record cheese export demand, the U.S. market being competitive, while these other markets were going up. Those other markets are going down now. So still very competitive, the U.S. market is. And those discounts are getting wider, but now New Zealand, especially, the largest butter exporting market on earth, starting to participate in the shedding of premium. So I think you can say that the US is very cheap, but does it matter more that New Zealand cheese and butter prices are going down? We know that, like every year, for all intents and purposes, New Zealand and Australia produce basically zero milk during the Northern Hemisphere summer. We're kind of on our way to them producing maximum amounts, and those maximum amounts happen between September and December. So I think the New Zealand market's gearing up for larger supplies, trying to fight for world market share at some point. And so that's probably been the dominant feature of the markets recently. It's not maybe the discounts. We will see pretty incredible export demand, but it's that these markets elsewhere are trending lower, not higher, because that has acted as kind of an anchor on the space. And otherwise, again, I think it's just the offsetting nature of production, and it's been never ending. We have bucked seasonal trends and cow herd evolution completely. So then the United States in the month of July produced 19.6 billion pounds of milk. It was up 3.5% year over year. You can see in this graphic that is growth that we really haven't experienced since post-COVID. So recovering from some very low levels. And otherwise, this is a number 3.5% that's at the upper end of the historical record. Or at the very least, we can say that milk production growth has returned on a lasting basis, and we're kind of back to some level of normalcy when we think about the U.S. milk market over the last 3 or 4 decades. So it's not a production issue anymore. There was a pretty significant supply and production issue between 2020 and really 2024, but those have been solved very quickly. Even bird flu, kind of the last gasp of disrupting supplies in the U.S., has been managed successfully. It's come and gone. And so we're adding an incredible number of cows, even to those states where bird flu was most significant, Texas, Kansas, South Dakota, and Idaho. Those states' growth in cow numbers have been pretty incredible. That's where most of the growth is happening, actually. Nationally, over the last year, we have added about 160,000 cows to the herd, which even if you had problems with yields and per cow output that we did see the last 3 or 4 years, that's kind of offsetting. It's just very hard to be pessimistic regarding U.S. milk production when there's just so many cows being milked today. And there still is the margin, I think, to keep those cow numbers intact in places like Texas, Kansas, and South Dakota. So we're adding to cows, we're not subtracting from the herd like we typically do post-spring. And it's just been pretty amazing to watch how fast the U.S. can produce large volumes of milk. Wisconsin's herd's down 5,000 head from a year ago, but it's been everywhere else that's just produced kind of an abundance of milk. I mean, I think we're soon to be awash in milk and cheese as these larger processing plants get access to raw milk for a sustained period of time. And thinking of some very large plants in Texas specifically, there will be no shortage of milk in Texas. So thinking philosophically, big picture economics, there's just no need to ration the available supply of milk today. That's different from the last 36 months. And that explains why the market's been doing what it's doing. The USDA in its September WASDE, which is due next Friday, probably has to raise its annual 2025 U.S. milk production, another 200 to 300 million pounds. They're already up 1.5% from last year at 229.3 billion, but that number will be getting larger in the September report, maybe the October report. What's been surprising to us is we can dial in large cow numbers and let us assume that the cow herd, the number that we see today, stays in place, into at least the early part of winter. But it's been yield coming back, growth of 0.5%, 1% milk yield year over year. That just kind of accelerates this increase in U.S. milk production. So spent too much time talking about just the simple fact that there is no shortage of milk in the U.S. And we probably see production gains not fully accounted for in USDA's annual U.S. balance sheet. And while exports, I think, are exciting, have been exciting, it's been the collision between, looking at the discount of U.S. dairy products to other markets, seeing that translate into, physical record exports of a lot of products. But at the same time, we had uncertainty over New Zealand. Would they produce more milk? Would Europe? Would the United States? Kind of exacerbates fear in the marketplace. And that's why we've seen pretty decent bounces or recoveries in the price of milk this year. And of course, why we saw, for the most part, $22 cash milk prior to the middle of 2025. But if we're growing milk production in the US like we are pretty robustly, and we're not seeing any production dislocation in places like Argentina and New Zealand and Western Europe, and the market goes back to thinking about just what do exports mean. And we all know this, but this is not New Zealand where we export, a majority of our butter production. Rather, we're exporting even today, 8% of butter production and 8% of cheese production. So it's manageable. I think given, putting the puzzle together the next, quarter or so, let us bump this up to 9% of production. It's still such that we're going to be producing enough to keep normal seasonal trends and inventories intact. Things will tighten as we get into Thanksgiving or so, but then loosen very quickly during the winter months. So again, no need to ration supplies, no fear in the marketplace on behalf of the end user community, and that gives you the market that we see now. I think what is new in the last 2 weeks, 30 days maybe, is just how weak the fat and butter markets have been. And I think it's easy to explain, but looking at the numbers, if we look at stocks numbers, we look at total disappearance numbers, look at how sizable the US butter export program is today, it's hard to reconcile completely. But I think what's happening is the end user community has been trained the last 3 years to be prepared for, what is pretty normal, but pretty significant supply tightness come October, November. If you remember 2 years ago, we had, a spike within a week to $3.50 per pound that caught everyone off guard. Last year, we still had pretty lofty butter prices, but it was this slow, steady, methodical move higher as the end user community gets prepared, gets inventory sorted out. This year, I think no one waited until the end of summer. They just got everything sorted out by the middle of July, to be honest. And this provides evidence for this, I think. So we look at the weekly butter sales volume, and not that this matches total consumption by any means, but this is kind of a proxy for how volumes are moving around. And so usually you have this spike in the volume of sales, September, October, just in time for the holiday baking season. This year, I believe we saw that spike about 90 days earlier than normal. So it's sort of the butter market to me, why it has been so weak, despite having such great export demand and really not abundance relative to domestic consumption, is thinking about the butter and the fat market as a game of musical chairs. And so once that game is over, sort of the bottom falls out of the market. And that's kind of what we've seen at the end of these short covering scrambles the last couple of years in November and December. It just happened in the month of August and the early part of September this year. And this does match up with price. So if you remember, June, July, we did have September butter, up to $2.76 per pound. It's kind of moving up every week, rallying, I think ultimately 30 or 40 cents. And then it's over. Right? So I do think that was the end user getting completely covered. That game is now over. We will revisit this about 12 months from now when the market does start to prepare again for a holiday baking season needs. But also know that butter production has expanded year over year, up to 10%, really each of the last 14 months. So similar to milk, just no need to ration butter once the end user has all of its supply needs sorted out. And so this is kind of the concern and why we're so focused on managing risk for the producing community, thinking about Q1. We do like selling forward milk, contracting forward, even at current prices, is what is normally a pretty seasonally strong time of year, August to October, has, I think, similar to what we just talked about in the butter market, come and gone. So if you look at the red line and the black and blue lines in these graphics, let's take the butter market, for example. It looks a little absurd, but the general shape of the trend of supply and demand and daily, weekly trading looks like it normally does. It just broke a lot earlier than normal. And so, again, I think we've sorted out a lot of supply issues. That U.S. milk production is growing. We're less urgent to, get things prepared for the end of this year. I think that's all happened. And so if these continue to behave normally, which, more or less they have for the last several years, we've had outsized moves both on the upside and downside, but the general trend has been intact. Again, it is kind of February, March, April that we're concerned about. And does class 3 have a 15 in front of it, at least briefly, Q1 2026? So let us pass that risk off to someone else and get along with things. And also, I think if you take one thing from this, I mean, it's pretty easy to see. Everyone knows what the cow herd is doing nationally. That we're producing lots of milk. That cheese processing capacity has expanded pretty significantly over the last couple of years. So those guys have access to ample supply. Will soon be producing a lot of stuff. It's everywhere else. So I think the real crux of this, and again, why we're active and hedging forward, is this is also happening in the competing markets. So New Zealand milk production in July, 312,000 tons, up 0.6% from last year. So not incredible growth, but for the most part does keep this pattern of 10 consecutive months of growth in place. Europe has also been surprising, and growth is happening in places like Netherlands, France, and Ireland, all pretty big net exporters of products. Production in Europe was 14 million tons, is up 200,000 tons from last year, or about 1.5%. And Europe, too, just pretty consistent, steady growth, and that's something that was not expected 3 months ago. But just a lot of milk available to the importing community. No one's chasing rallies. That's what that means. And so there's really just no fear of shortages today or in the next 6 months. So just again, to reiterate, it's that foreign production is also rising. That's the biggest concern to us. And China is still an issue. I think that's the big deal. Does China exit the US dairy space like they did in the month of May and April? Or do we kind of avoid big time retaliatory tariffs on US dairy products? I think right now the sorghum market in the US and the soybean market specifically are being held hostage by US Chinese trade tension. With that in mind, this tension seems to be getting worse, not better. So when we can kind of see this acceleration and changing world maps, you know, Russia signing a deal to export pretty sizable volumes of natural gas to China via Siberia. They're becoming more friendly. Even this week in China, the celebration of the end of World War II this week featured a lot of pictures of North Korean, Russia, and Chinese leaders together. They're becoming pretty good friends, it seems. And so, is there this decoupling from the West and the East, and what does that mean for trade flows? We will all kind of separate ourselves into certain markets. The U.S. will have a market like Mexico and Latin America, which is incredible, but will we have lost China forever? That is something that we're at least entertaining. I mean, what is the end of this trade war? I mean, does China buy a single bushel of U.S. soybeans, or do they not? And that's a big question to us. Though already, again, the feed market outlook's pretty simple. We can debate whether perhaps December corn has already posted its annual low or not. I can't disprove or prove that it hasn't yet. Maybe these corns posted as low. But generally speaking, it's the recovery effort that's going to be so challenging, just because we're building supplies of things, and this is similar in the U.S. and globally. So the USDA, assuming its demand and yield numbers, projects combined major crop stocks at 3.3 billion bushels, which is not insightful. That explains why the markets have done what they've done, dropping from $8 to $5 to $4 corn, existing soybeans below $10 intermittently. That this is all easy to explain. We are concerned, though, that maybe the stockpile grows to 3.8 or 3.9 billion bushels, and the difference will be disappearance. So very soon, I think once we get past the September crop report, maybe the market's focus probably transitions from supply. Weather has been, for the most part, very good. We all know this. Crops are big. To how fast we make these stockpiles disappear. And we have talked about this on the Dairy Signal, every couple of months or so, but wanted to bring it up again because it's not just that the U.S. and China hate each other, and we're at war trade-wise. We're both vying for economic dominance 2 decades from now. Who wins the chip race? Who wins the artificial intelligence race? Things like that. Even before 2016, there were structural challenges developing in China's economy that do, I think, have a direct impact on food consumption, and especially imports and import growth there. China's population is contracting. The newest IMF estimate is now between 2023 and 2028. China will have lost 14.5 million people. Such contraction is really only occurring in a few places: Russia, Ukraine because of war, Venezuela, and China. So it's not a list that you wanted to be added to. And now Chinese economic growth is just pretty unremarkable. It's almost similar to kind of mature economic growth in places like Western Europe, US, Canada, Australia. it's very hard to grow the US economy when you're creating trillions of dollars of GDP. China's got here very quickly, and I think this is all because, or a function of, them just having fewer people to work, to buy things, to produce things. In the long run, of course, population growth is economic growth. China's going to struggle with this, and this is a generational issue. And I don't think that they've lost, a couple million people in the last year means that immediately they stop buying things, but it is at least correlated. So China a year ago, crop year 23-24, and I think in order to satisfy the domestic market, purchased in the import space 23.5 million tons. They were tied with Mexico for being the world's largest importer 1 year ago. This year, we can track boats, and trade is kind of the one truth that we can see is we know what the boat's name is, where it leaves, what's on it, where it's going. We count all those boats. China, for all intents and purposes, in crop year 24-25, has bought zero corn. I think they average 150,000 tons per month. The annual total probably is something like 2 million tons, 2.5 million tons. The USDA today estimates Chinese imports in 24-25 at 4 million tons. So this by itself has lopped off 12 million tons of global corn trade. And we'll touch on the domestic market in China. So it does seem like these economic issues in China are having an impact on food imports. They're importing a lot less or nothing in certain products. Non-fat dry exports, thinking about baby powder and birth rates. And again, I don't think this is one for one because a year ago and 2 years ago, China's population was contracting, yet they're still importing pretty large tonnages of non-fat dry from the US. But this year, similar to corn, for all intents and purposes, in almost zero. So I think we've averaged 450 tons per month of non-fat dry exports to China. A year ago, that was about 1,000 tons. And even annually, something has changed in China. Their demand for non-fat dry from everywhere, trade issues with the US aside, has dropped by 35% to 229,000 tons. Doesn't change in calendar year 2025. So again, this is just something to be considering as we're thinking about managing forward risk. So think about forward premiums in the soybean market, the wheat market, the corn market. If you've lost the world's driver of our world ag trade in China, which we think we have done to some extent, it's very important to think about as we get chaos in the markets because of supply and whether we don't have the demand driver that we had 2 and 3 years ago. I think that's very, very important. And so China not importing any soybeans from the US, imported, basically zero corn. Hog herd is contracting in 2025. But if we take a look at the snapshot of the domestic ag markets in China, they're not telling us that those markets are imbalanced. If anything, they're telling us that they've found perfect equilibrium, or maybe there's a bit of oversupply, just a tinge of oversupply in a lot of markets. So this shows spot hog future, the spot hog future in China over the last 3 years. And that market has been stuck at about 13,200 yuan for 10 months. It's done nothing. You can see the red line in the graphic on the left totally ignored what are usually pretty positive or bullish seasonal trends as you get into the late part of summer. That did not happen at all. 50% of the world's hogs in any given month live in China. So I think this is important to think about total protein consumption worldwide. We're not going to get China contributing to growth of that. Again, imports of soybeans are down. They've imported little to no soybeans in calendar year 2025 from the US, and yet the soybean meal market in China has done nothing as well. $417 per ton. That compares to about 2 years ago, $634 per ton. You don't have a great import margin in China, and so that's the big concern. Similar to the hog market, about 20 or 25% of the world's soybean meal at any time is in China. So this is a pretty good benchmark for supply and demand globally. The corn market in China has been weak, and it's been getting weaker despite kind of the end of the crop year coming up. Today, Chinese corn's $300 per ton, $330 per ton a year ago in late August. And so at $770 a bushel, it's way above, the world market. But the import margin, when you factor in every single thing, pretty weak. So the Chinese corn market's not telling us that there's some dire shortage of supplies, that there's even today a lot of incentive to import corn. The reason that we're talking about this is, thinking about trade deals, does it involve ag? 2018, 2019, China was rebuilding its hog herd. And so maybe that was kind of the core reason that the phase one deal was signed, is that they knew they needed a lot of ag stuff. At least today, and this could change with a strike of a pen at any time or in 2026. It doesn't seem like that. The landscape in China is similar to where it was in 2019. I don't think they need a lot of stuff. And getting more specific in how this is impacting, the U.S. farmer, especially in the upper Midwest and northern plains. China has not bought 1 bushel of U.S. soybeans for new crop delivery. We are getting the rest of the market, non-Chinese demand, but even that's unchanged from last year at about 7 million tons. And so you can see here, this is what's been committed to be exported in the new crop marketing year as of the end of August. And it's down the lowest since 2019, pretty historically low. And mathematically, this gets concerning if it doesn't change in the next 30 days, because by December 1st, more or less, we have sold 60 or 65% of the annual soybean export total. That's pretty locked in. And so if that number doesn't get larger between now and then, we're concerned the USDA is going to have to lop off, 300 million bushels from its U.S. soybean export program. And it sounds like a big number, but again, getting into what's happening between the U.S. and China, this shows the seasonal evolution of U.S. soybean exports on a monthly basis, and it's rigidly seasonal. Two hemispheres now produce a lot of soybeans. The U.S. dominates trade between September, December, January. The Southern Hemisphere takes over after that. That's a fine relationship. But China's not bought anything for September, which it's September now. If you were to buy, let's say, a bushel of soybeans in central North Dakota, gets put on a train, goes to the West Coast, gets shipped to China, that whole process takes about 6 weeks. So if soybean exports at this point, soybean exports in bulk to China begin at soonest the middle of October. If we don't see any sales in tomorrow's export sales report, then we kind of push that to October 20th. That is peak soybean shipping time, really for the entire market, but especially to China. And so we think that already we have lost maybe 9 or 11 million tons, or 330, 400 million bushels of potential demand that doesn't come back unless there's just cripplingly adverse weather in South America. If this gets pushed into November, do we raise that number from having lost 9 or 11 million tons to 14, 15, or 16 million tons of demand? And so these are all press releases, but China is hinting that they think they can manage their way through to the beginning of the South American soybean export program in late January and February. It's not something that we like to hear, but we have seen them, and we can track this, they're selling reserve stocks into the domestic market now. So they're doing all they can to continue to shun the U.S. soybean market. We've even caught wind of them buying a few cargoes of soybeans from Uruguay, which is pretty abnormal, but they're kind of squeezing all of the supply that exists in South America in order to not buy U.S. soybeans. So, the trade policy and certainly in the U.S. hasn't had much of an impact when we think about the total ag space. Retaliatory tariffs outside of China don't really exist. So we've got normal grain flows between us and Mexico and Europe, a lot of Asian countries, but it is the U.S. and China that is the battle, and it's the soybean and sorghum markets that will be most exposed to this. And cash markets are starting to reflect this, and they may not be done reflecting this, given, I think, the upper Midwest, Wisconsin, probably, Minnesota, and the Dakotas, yields, corn and soybean yields, perform best relative to history, just looking at crop ratings, vegetation health compared to normal, and of course, I think rainfall through the end of August. But we look at spot soybean basis in a market like Castleton, North Dakota, so eastern North Dakota, and it's never terribly strong. But in the last 2 weeks, it has dropped from 75 cents below the Board of Trade to $1.50 below the Board of Trade. That's because a lot of these beans, a majority of these beans, are grown to be put on trains, shipped to the Pacific Northwest, and exported to China. There's no book for China at PNW. So where do these beans go? And the market's clearly telling us that they're going to struggle to put them somewhere. We're hearing from some clients too that because of corn, edible beans, soybeans, those elevators are going to be over capacity come harvest. And that, I think, explains the basis weakness there. And if you start to do calculations, and I think a lot of the cash grain traders are doing this now, I mean, basis could get to $1.75, $2 under the Board of Trade in certain markets of the Northern Plains. So, U.S.-Chinese trade tension is directly impacting the Dakota soybean farmer. Does this cascade into surrounding markets over time? We will see what final yield is, but you don't want to see a chart like this, and it's hard to be bullish because of supply if you don't have demand growth. And again, this is a pretty big concern in cash markets generally. Now, I know we don't really care that much about sorghum, but we will jump to this. I think it's kind of important when you think about just the cash feed markets, which should work in the dairy operations favor. But if you're a producer, again, we like hedging on recoveries, using forward premiums to sell 2026, managing this risk appropriately. Anytime U.S. sorghum exports are robust at all, let's say above 125 million bushels annually, it's because China is buying large tonnages of U.S. sorghum. China does not have to get an import quota. There are no phytosanitary issues with the U.S. sorghum market within China. China's left like they have the U.S. soybean market. And so far, in the marketing year has basically ended, we have sold 71 million bushels of sorghum abroad in the 24-25 crop year. Why that matters and why you see the red line, percent of the USDA's forecast being so low, the USDA still has penciled in 95 million bushels. So most likely, we're going to throw another 20 million bushels of stocks of sorghum into Kansas, Texas, and Oklahoma. Stocks are going to be, 75 million bushels this year in stocks. China's not bought a bushel of sorghum from the U.S. for new crop delivery either. We're getting some demand from Mexico, but that may be our only customer if U.S.-Chinese trade policy or negotiations don't progress. And the reason I think this is important, if we look at the annual sorghum balance sheet, so again, we think that final 24-25 in stocks will be not 52 million bushels, but maybe 70 million bushels. And if we kind of throw that into the new crop balance sheet and think about the USDA, as of now, calling for sorghum exports to more than double next year. That only happens if China comes back. Rather, we think we can shuffle around some things. Maybe we maximize ethanol sorghum use in ethanol production. Feed use will be maximized, so we'll raise those numbers. But if exports of sorghum are no larger than 125 million bushels, let's say, there will be 80 million bushels of sorghum in the Central Plains with nowhere else to go. This is after all of it's been fed to the max. It is being maximized at ethanol plants, and still we have this pretty abundant supply. And for context, this is what that looks like. So this number, if realized, will be the highest since 1992 and suggests that feed operations are going to have an abundance of supply to choose from. Thinking about the lack of problems in this year's hard red wheat crop, stocks of HRW are forecast to grow to about 420 million bushels, which is pretty historically large. The sorghum market somehow or another has to encourage consumption growth. And of course, those corn crops in Kansas, Nebraska, Colorado are going to be much larger than normal. So again, thinking about the physical cash market, is that the next shoe to drop in things like soybeans, corn, wheat, sorghum? It is already very weak. And so even today, the sorghum market is doing its best to be maximized in ethanol production and in feed operations. Hays, Kansas sorghum basis is $1 below the Board of Trade. So periodically, we have seen sub $3 cash prices in central Kansas. Hard red wheat, still very weak, 75 cents below spot Kansas City. So that market's already competing with corn feed use as well. I just think that the Kansas, Nebraska, Texas, Oklahoma feed market specifically will be oversupplied. It's going to be tough to find homes for all of this stuff. So again, we will debate yield, corn's chart pattern. We've had a nice bounce, but in the end, from a big picture, I think at best that market is neutral. There will be no fear of supply shortages unless there is major problems in South America. And kind of lastly, just wanted to bring this up. It's something that's been kind of lost in the chaos. As of now, as on October 14th, there will be a $50 per ton fee on vessels arriving at U.S. ports that are either owned, operated, or built by China. This could be pretty disruptive. I don't think to ag trade specifically. Some protein meal gets put on containers. I want to note too, bulk grain cargoes are exempt from this, but thinking about consumer goods, I think it's just going to be very disruptive if this is not changed. And you can see here that, over the course of the next couple of years, those fees get pretty prohibitive. So this is all kind of part of the trade war that's ongoing, but just wanted to bring this up because this is now just, 5 or 6 weeks away. Does it happen? Thinking about the sort of macro financial markets, not going to be wanted for sure. And China's been preparing for this for a long time. So again, I'm sorry, it's somewhat pessimistic, but just thinking about the odds that do we redo the phase one trade deal? China's, again, if they're correct, they have been sourcing ample supplies of soybeans from South America, including countries like Uruguay. They've just been investing in a lot of things to kind of decouple themselves from the West. And so here you've got countries that traded most with the United States or the most with China. The blue is US, the red is China. In 2000, of course, China had very little influence in the world of agricultural or really physical good trade. But fast forward to 2020, that's changed pretty substantially in that the US's influence is smaller than China's. So they've been prepared. This is, probably goes back 3 or 4 decades, but this is something that we're concerned about with respect to the idea that does China decouple from the US permanently? Have we lost that soybean market, that sorghum market? Do we kind of trim Chinese purchases of dairy products? So that's why we've been focusing on China. And it's a big deal to us and a concern. Otherwise, again, still no secrets, kind of like the milk supply and milk production. We're going to produce an incredible global crops this year. Total crop production, assuming USDA is close to correct, will be just over 2.5 billion tons, the highest ever. And even, a year ago, we were concerned that productivity had plateaued. We just cannot break through. When we look at all major crops combined, what is yield? Have we run out of technological advances? We had some pretty chaotic weather from 2017 to really last year. We've broken through that this year. Mother Nature has been kind to both hemispheres for about 12 or 14 months. The combined major crop yield this year, and I think this will be correct, is about 4 tons per hectare, back to normal growth of a couple of percentage points. And even since the USDA's August report, we've seen places like Australia raise wheat production because of favorable weather. Canada has raised canola production because of favorable weather. And so does this number stay the same or even get larger September, October, November? What is South America's crop next year? Well, you just really haven't seen problems outside of select regions. Canada, Mexico, Western Europe, Ukraine, all doing pretty well weather-wise. What you're looking at here is July 1st to September 1st, percent of normal rainfall. Some spotty issues in the Canadian prairies, but August was pretty substantially wet there. That's, I think, salvaged a lot of yield potential, so those crops will be bigger. The spring wheat balance sheet in the U.S. will benefit from pretty large access to Canadian spring wheat. Mexico has been outright wet this summer. You look at June 1st to September 1st, percent of rainfall here, and you can see that a lot of access to water. Water will not be a problem like it really was pretty steadily between 2020 and 2023. Mexico is still going to be an incredible market for U.S. ag. Dairy specifically, they will be the largest corn importer on earth and probably take, 950 million bushels of U.S. corn this year. But that will be the same number as the previous year and the year before that. So I think because of weather, Mexico won't increase its demand for imported corn. And again, that's just because Mother Nature, very kind, weather has been very good. And of course, in the U.S., that's been the case as well. This is no secret. I mean, we do have recent budding dryness in parts of central Illinois, Indiana, Ohio. But when we kind of take a step back and look at May 1st to September 1st, you're not going to go back in history and find any yield problems here. And looking at crop conditions and even tours traversing the Midwest today, everything kind of matches with the USDA's forecast. Thinking about 189 bushel an acre corn yield, which sounds absurdly high, is still only about 3% above the linear trend. That is very much within the realm of history. When we think about favorable weather and yields compared to the linear trend, this all fits. So our own tour of Illinois and Iowa kind of validated this, but now this is almost 30 days ago at this point. But we found 22.5 million kernels per acre in Illinois and Iowa combined. We put that against the USDA's current Illinois and Iowa corn yield, and it is almost perfectly aligned. Maybe they lower it 2 or 3 bushels per acre, but that's about it. We also kind of supersede Pro Farmers Tour, and we follow 14 tours that trample across either various counties or the entire state of Illinois. 8 of them have reported so far, and that's what you're looking at on the right. So they've been mixed, but for the most part, very good. And this number is also perfectly aligned with the USDA's 221 bushel per acre Illinois corn yield forecast. So I do think they lower corn yield in the September report next year. I just want to communicate maybe it's only 1 bushel, 2 bushels per acre. Will that be viewed as disappointing? When you put all this together, no real production threats in the U.S. Even regionally, some kind of crop finishing rains in places like the Western Corn Belt, the Dakotas, Minnesota, parts of Wisconsin. We even got some pretty decent rain in Illinois and Indiana, and we'll get some more in Kentucky in the next 24 hours. We think that total production, everything from barley to edible beans, sorghum, corn, wheat, the whole gamut will be about 23.5 billion bushels this year. Based on USDA's annual survey on December 1st, 2024, storage capacity was 25 billion bushels. Storage capacity has grown very slowly. So this year, putting the two together, total U.S. crop production will be 92% of storage capacity. So not 100% or 101%, but this is the highest number we have seen since 2016. And that was a market that just very broadly had to look for demand growth, waiting on supply issues to rally. And I think that's sort of the market that we're coming to once again. As we think about the U.S. corn balance sheet and why our number for combined crop stocks was higher than USDA's, it's because we're going to have competition. It's going to be not so easy compared to last year, especially, to get rid of this stuff. Ukrainian corn, for example, was basically unbuyable during the summer. They had zero corn. If you wanted Ukrainian corn, you had to pay $2.50 above the Board of Trade to get it. We fast forward, that market has rolled over to a new crop position, and now it's offered $1.20 above Chicago corn. That's about where the Gulf market is. Argentine corn has fallen 30 cents per bushel just in the last week. Brazilian corn also down 30 cents per bushel. So all of a sudden, it seems like those markets have satisfied domestic use. Now they're kind of destocking, pushing the surplus into the global market. And so we need to very carefully watch if this impacts U.S. corn export demand moving forward. But looking at this graphic, the blue line being below the red line doesn't bode that well for future corn export sales relative to the last 2 months. And I wanted to show this as well. This shows us one that U.S. gasoline consumption's plateaued through the end of August. It's down almost 1% year over year. I don't think that's bearish of energy use, but to grow ethanol consumption guaranteed, I think we need to grow gasoline use because for the most part, ethanol demand is gasoline demand. We don't expect a lot of excitement in the gasoline sector over the next 12 or 24 months. On the right, you've seen we've been using fewer bushels of corn to produce ethanol the last several months. And that is, I think, partially because yields are up, partially because ethanol production is slowed. But I think this shows pretty clearly the impact as well of maximizing already sorghum use as a feedstock at ethanol plants. So I think we may struggle to grow ethanol use in 25, 26. And so the reason I say that is because here is what we think the balance sheet's evolution will be. So a lot of numbers on here. We have trimmed U.S. corn yield 2 bushels an acre below the USDA. But we also have taken exports down 200 million bushels and ethanol use down about 50 million bushels. The net result is 2.4 billion bushel in stocks. It may not be exactly correct. This is something we'll take week by week, but what I wanted to show here is that let's preliminarily look at the 26-27 balance sheet. And predicting the future is impossible. All these numbers will be forced to change, but just for the sake of providing a framework, let's carry those 2.4 billion bushels over to next year. We will strip the corn market of 6 million acres of potential production. We'll use trend yields, trends in consumption, kind of assume normal weather in South America. And so despite having lost in this balance sheet 6 million acres of corn, you're still left with 2.1 billion bushel in stocks. And so that's, I think, the message we want to communicate is we may be stuck with these prices for a long time unless one of these numbers changes considerably. And that's pretty easy to identify. That it's either Chinese buying or it's a major weather problem in the Southern Hemisphere during our winter and next spring. In soybeans, we sort of take those 6 million acres we stole from corn, put it into the soybean balance sheet. And we also have taken down our export forecast about 300 million bushels from USDA because of what we talked about, already having lost 9 to 11 million tons of potential Chinese demand. So the soybean balance sheet is one that kind of continues to expand, gets looser every year until there's a weather problem or Chinese buying. So that's the high level message in the feed markets is that's what we need to really be bullish these markets. So every day you wake up, keep an eye out for potential Chinese demand or moving forward trade negotiations or South American weather problems. Now, so far, Mother Nature continues to cooperate. So again, do we fast forward 100 days and we have no problems in South America? Who knows? I don't know. But I know that the climate updates are released the 15th of every month. And so as of August, at least, here is their precip probability forecast for South America. Major South American crop areas are highlighted. No real problems. The details we don't have a lot of confidence in. But I also wanted to show you what's happened in the month of August. This is, rain gauge measured rainfall. Argentina is seeing 3 to 7 inches of rain. That is about 600 to 1,000% of normal. Drought has ended there. The same is true for eastern Paraguay and southern Brazil. So they're already starting to plant next year's crop a little earlier than normal because soil moisture is abundant. All we can say now is that Argentina is not going to have a water problem for a long time. We will see how November, December evolves. But is this the sort of basis for this climate forecast proving correct just because it's been so wet so far? And same with Australia. And this is really a wheat and barley issue, but does that have a knock-on effect on the margin a little bit for feed grains? So the climate forecast in August was, outright wet for Australia during their critical growing season, September to November. And so again, confidence pretty low in any of those details, but it has been adequately wet over the last 30 days in Australia. And that's what you're seeing on the right, percent of normal rainfall in the month of August. Wheat and barley areas are highlighted. A few issues, but for the most part, no problems. And the Australian government just this week raised its wheat production forecast by 2.8 million tons. So it does seem like global yields pretty strong, maybe getting higher when we look at all crops combined. Just not having that supply loss is, I think, a pretty core feature of the grain marketplace today. And so until that changes, there'll be drought in Argentina in December or Brazil. You're kind of, again, stuck with these markets. And that's been the case. That's a pretty normal, feature of the ag market landscape here is, these charts show just the similarities between June 2010 to 2020, that decade. That is the orange line. The x-axis is time, the y-axis is price. And so we followed that pretty closely, and that doesn't tell us much other than bull markets like we saw during that period tend to last 2 to 4 years, and that's about all you can hope for. That makes sense. So issues tend to get solved, etc. But until there's the next problem, drought, demand growth. I mean, does the green line in both corn and soybeans follow the orange line? And we think that more or less until you threaten us with something supply-wise, changing world trade flows probably does. So that's what we want to be prepared for. December corn at 4.18 today, not terribly newsworthy. We know why that's the case. Maybe it's already scored its low, but we do think corn's kind of a $4 market for the next 12 months. Soybeans probably $9.50 to $10.50 for the next 12 months. That's what we want to be prepared for. So as always, too much information. If you have any questions now or later, here's my contact info. Please don't hesitate to reach out if you've got risk management questions. So thank you so much for your time.
Thank you, Ben. And you said it well, so much information. Thank you for sharing or making your email address available so that we can contact you at any time when we have questions. I heard a few things, lots of records we've been making in U.S. total dairy exports. We're exporting record amounts of butter, global major crop production, the highest ever, and U.S. grain storage capacity, the highest ever. And who would have thought that we could be in September of any year and hear somebody say that Mother Nature and the weather has been relatively kind to everybody. That's not something we commonly hear. Thank you, Ben, for all your expertise every single time you show up with us here on the Dairy Signal. The information you present is valuable. It helps us make wise decisions on our dairy businesses, and we appreciate you. Couple of notes before we say an official goodbye for today. If you're here to capture some DACE continuing education credits, be ready to take the quiz, submit your answer, and make sure you submit it all the way so that we can give you the credits that you came here for. And be sure to tune in again next week. We'll have another Dairy Signal episode on Tuesday. And thanks once again to our sponsor of today's program, Dairy Management Incorporated. We appreciate you. Ben, any final words of wisdom?
Be prepared for changes. Ag markets are, of course, very cyclical. Let's just get ahead of this before we really get into that, lasting cycle of deflated prices.
Thanks, Ben. And to everyone, have a great week. Till next time.